Whenever you see a massive candle like this, okay, a huge, good buying candle here, what do you do? Do you sell here immediately or do you buy at this point? You cannot sell because there is a good buying pressure. That's why the market has given such a great rally and it would continue, right? You cannot sell at this point. You cannot buy also because this big candle low is going to be a stop loss. You cannot sell, you cannot buy. So most of the traders feel whenever there's an impulse move like this, they cannot be on the sell side nor on the buy side, but they have to wait. Right, so that is what today's video is going to be about. It's going to be about fair value gaps. So whenever there is an impulse move like this, okay, there's a good green candle or a good red candle like this, it creates imbalance in the market. Okay, due to one-sided pressure. In this example, there's a buying pressure, right? There was a good green candle here, again it started going up. So a good buying pressure here, creating an imbalance. Again, if you see on the sell side, the red candle also has given a good move due to which there is an imbalance. Nothing but one-sided move. Okay, it could be only buying, sudden buying that's happening here or sudden selling. So whenever the price creates like this, there is a gap that is been formed between these candles. So how do you identify that? This is going to be a first candle. This is the second and the third candle. You can see connecting the first candle's high and the third candle's low, we have a gap in between these two. So these are the gaps. Okay, again for bearish candles here, you can see this is a first candle, second and third candle. The first candle's low, third candle's high. This is going to be a gap. So what does this gap do? Whenever there is gap in the market, it means there was only one-sided, one direction move that happened. It could be buy side or sell side. So what the market does is, in order to get balance, the price could come down to this level. Okay, so what happens when the price comes down to this level? This will act as a good area of support and the price starts going up. We'll see a few examples of the same. Okay, in this example, you can see this impulse candle, right? This is the candle that we're talking about. You can see how strong this candle is. Okay, so the immediate next candle, you cannot take any decision, right? You cannot sell your, you cannot buy your. That's how it is. But when you connect the first and the third candle, you would see there is a gap, right? You can see the price came inside the gap, filled this, took this area as a support, and again started going up. Okay, and if you see again from this area to the next area, we have another gap. There's also one thing that I'd like to add here. You can see we also have a bearish gap here. Okay, this was a bullish gap and this here is a bearish gap, right? This was our first candle's low and the third candle's high. Because the price is coming down, this is called as a bearish gap. So whenever the price is making two gaps like this, there is a bullish gap here and also there is a bearish gap here. What do? Do you expect the price to go up to this bearish gap, take this liquidity and again start coming down, or do you expect the market to come down to this level, fill this gap and move up? So whenever there is two bullish and also bearish gaps like this, you need to see in which trend the market is. Okay, here the market is in an uptrend. It has taken out the chalk already. So here you need not focus on the bearish gaps. You need to blindly ignore it. Whenever the market is in downtrend, you can look for bearish gaps. But when the market is in uptrend, you need to only focus on the bullish gaps. Okay, so here the price comes down, fills this, just ignore the bearish gap here. Again, the price makes a new gap, bullish gap. Right, 1, 2, 3. Third candle is going to be very important for you. This has given you a good green candle here. If you extend, you can see what has happened here. Right, you can also plot our Fib 0.5 level here from the bottom to the top. You can see 0.51. Okay, so whenever the 0.5 is here, most likely the price will start going up from here. Okay, it will take as a good support and go. You can also notice once, twice the price is reacted, but the third time it sweeps all the liquidity. Right, from here it has given a sweep, breaks this low, grabs all the stop losses here and again continues going up. Okay, so that's how you mark a fair value gap on a bullish trend. We'll see few more things here. You can see the first candle here, third candle here. This is our gap. When you extend it, you can see this candle went inside the gap again. So it was a tiny red candle here. And soon after taking support from this area, it started going up. So all these fair value gaps that you see will act as a area of support or resistance. If it is in an uptrend, it is going to act as a support. The price bounces from that area, starts going up. And if it is in a downtrend, it is going to take as a resistance and start going up. But just because you have a gap, bullish or bearish, you're not going to take entry only based on that. Okay, it would be very messy if you do so. You can see we have another gap here. We also have another gap right here. Right, the first candle and the third candle. When you extend it, you can see take support. If you're trading only based on support and resistance, it will hit your stop loss. This is a 4-hour chart. Okay, so it gives you a breakdown, taking all these liquidity here, and then again it starts going up. Okay, so this was about today's video. You need to know how to identify fair value gaps. We will learn about the entries in the coming session. Okay, but I can give you a few more examples of the same. You can see this is the first candle, second candle is this, and this is a third candle. But it did not create a major gap here. It was a very tiny gap here. This is the first candle, and this is the third candle. Again, it reacted, went up. Okay, so, and then the price played in this range for some time here. Okay, and then it created a gap here. You can see there's one green candle here and a very tiny fair value gap. Take support, goes up. So anytime you're taking an entry based on fair value gap, you're not going to completely depend on this alone. But if you're taking a trade based on this, the stop loss is going to be right below this. Can you imagine how small your stop loss is going to be? Right? And you're going to get previous high or 1:3, 1:5 as your targets. Okay, you can again see there's another gap here. I can just continue just doing this. The concept is clear. This is one gap we have here. The price takes support, again starts going up, and it just continues doing so. So whenever the market is in an uptrend, you will be waiting for a bullish gap to be filled, and you can look for an entry. There's volume entry. There's a lot of other conditions too that we have to check. But once the previous low has been taken off, as far as the market has been making higher highs, you can trade on a bullish gap. But once the previous low has been taken out, for example, if this low has been broke, we have already learned that's going to be our first condition. After that, whatever gaps that you have, if you find a bearish gap and when the price gets to that level, you can look for an entry there. Okay, so that's how you read which side of the liquidity is going to be taken out. If you have huge gaps not been filled, it means the price would most likely, in order to get balanced out, it is going to come down to that level, fill that gap, and then go up. Okay, so yeah, that is it about this video. If you like the video, hit like and also do subscribe to the channel.